William Gann, a legendary figure in financial markets, didn't just predict price movements. He claimed to foresee market turns with an accuracy that often exceeded 90%, not through guesswork, but by understanding the underlying order of the universe itself. His methods, shrouded in mystery and often dismissed as esoteric, offer a profound alternative to conventional technical analysis, promising a deeper insight into the market's true rhythm. Today, we're going to demystify three of Gann's forbidden secrets, adapting their core principles for beginners to help you unlock a new perspective on market forecasting and potentially elevate your trading accuracy. The first and arguably most pivotal of Gann's secrets revolves around the concept of time cycles. Encapsulated in his profound statement, "Time is more important than price." While most traders fixate on price levels, Gann believed that time itself is the ultimate driver of market movements. He observed that markets do not move randomly, but rather in accordance with predictable cyclical laws, much like the changing seasons or the phases of the moon. This isn't about arbitrary dates, but about the inherent rhythm and memory of the market. The core principle here is the law of repeatability. Market history, Gann argued, repeats itself through consistent cyclical patterns. By identifying these recurring patterns in time, one could anticipate future market reversals with remarkable precision. Imagine the market as a vast, complex clockwork where specific durations consistently trigger significant shifts. These significant time periods or cycles could be short-term, such as 3 days, 3 weeks, or 3 months, or even 90 days, which represents a quarter of a year. Longer-term cycles, spanning 5, 10, or even 20 years, reveal the grander ebb and flow of economic and market forces. The power of understanding these cycles lies in their ability to predict potential turning points. When a specific time duration from a previous significant high or low is completed, the probability of a new major market move or trend reversal significantly increases. For a beginner, the practical application begins with simply observing and measuring. Start by looking at historical price charts of any financial instrument, stocks, commodities, or currencies. Identify major highs and lows. Then, using a calendar or your charting software's measurement tools, count the number of days, weeks, or months between these significant turning points. You might begin to notice patterns. For instance, a common and often effective cycle for intermediate trends is the 90-day cycle, or approximately 3 months. If a major low occurred 90 days ago, the market might be ripe for a significant shift, either a strong continuation or a reversal. This isn't a guarantee, but a high probability area to watch. Furthermore, Gann paid close attention to specific calendar dates and seasonal influences. Certain times of the year, like the end of quarters or specific astrological alignments, though we won't delve into the latter's complexity here, often coincided with trend changes. While this might seem abstract, simply noting historical performance around these periods can offer clues. Finally, for short-term confirmation, Gann's rule of 3 days is invaluable for beginners. If the market forms 3 consecutive days with lower highs and lower lows, it's a strong indication of a potential downtrend. Conversely, 3 consecutive days with higher highs and higher lows suggest an uptrend is forming or strengthening. This simple rule provides a quick, actionable confirmation signal based on the interaction of time and price. The beauty of these time cycles is that they compel you to look beyond the immediate noise of price action and consider the broader temporal context, adding a crucial dimension to your analysis. To truly grasp the foundational insights that shaped Gann's revolutionary approach, one must turn to his own words. His classic work, Truth of the Stock Tape, offers an unparalleled journey into the mind of this trading maestro. While the original charts within the book might suffer from the limitations of early 20th century printing, making them appear somewhat rudimentary by today's standards, the wisdom contained within the text is absolutely priceless. Gann meticulously explores the underlying market cycles, the psychology of speculation, and the timeless principles that govern price movements. It's not just a historical document. It's a masterclass in understanding the enduring forces behind market dynamics. Reading it is like having a direct conversation with Gann himself, offering you his personal perspective on how to identify opportunities and manage risk. For anyone serious about understanding the deeper mechanics of the market, beyond superficial indicators, this book is an essential read. You can find Truth of the Stock Tape and begin your journey into Gann's original teachings through the link provided in the description below. Moving on to the second secret, we delve into geometric patterns and angles, which reveal the profound harmony between price and time. Gann believed that market movements are not chaotic, but are governed by universal geometric relationships, where the balance between price action and the passage of time manifests itself through distinct angles and shapes on a chart. This is where the visual aspect of his analysis truly shines, allowing traders to see the underlying structure of market movements. The cornerstone of this secret is the concept of Gann angles. These are not just arbitrary lines. They are geometric lines drawn from significant highs or lows, designed to reflect the speed and rate of price movement relative to time. The most fundamental is the 1-by-1 angle, also known as the 45-degree angle. This angle represents a perfect balance where price moves 1 unit for every 1 unit of time. It acts as an incredibly powerful level of support or resistance. When price respects the 1-by-1 angle, it suggests a healthy, balanced trend. Other angles, such as 2x1, price moves 2 units for every 1 unit of time, indicating a faster trend, or 1x2, price moves 1 unit for every 2 units of time. Units of time, indicating a slower trend, provide crucial insights into the momentum and strength of the current trend. For a beginner, the interpretation is straightforward. When price breaks below an ascending Gann angle, it signals a weakening of the upward trend, often directing the price towards the next lower angle, which then acts as potential support. Conversely, breaking above a descending angle suggests a weakening downtrend and a potential move towards a higher resistance angle. This gives you a clear roadmap of potential price paths and turning points. Beyond simple angles, Gann also utilized the square of 9. This fascinating spiral numerical tool helps identify key price and time levels based on mathematical and geometric principles. While its construction can seem complex, its application for beginners can be simplified. It helps to pinpoint potential price levels where significant support or resistance might emerge, or where reversals are likely to occur. It essentially takes a central price point and spirals outwards, revealing mathematically significant numbers that often correspond to market turning points. By using the square of 9, traders can identify potential targets or reversal zones that might not be visible using traditional Fibonacci or pivot points. Gann also incorporated other geometric figures like squares and triangles into his analysis, using them to map out market cycles and zones of price-time balance. For practical application, beginners can start by using charting software that offers Gann angle tools. Plot these angles from significant highs and lows. Observe how price interacts with them. Does it respect the 1-by-1 angle? Does a break of a 2-by-1 angle lead to a faster decline? Experiment with plotting the square of 9. Many online tools or charting platforms offer this by inputting a significant market high or low. See if the price levels generated by the square of 9 correspond to past or future support/resistance zones. The key takeaway is the synchronization of price and time. When price reaches a specific geometric level, like a Gann angle or a square of 9 level, at a time indicated by a time cycle, the probability of a significant market reversal or acceleration dramatically increases. This confluence of factors is where Gann's methods truly begin to reveal their predictive power. The third, and perhaps most elusive of Gann's secrets, is the law of vibration and comprehensive analysis, which emphasizes the synergy of all market factors. Gann's law of vibration is often misunderstood, viewed as a mystical concept. However, for beginners, it's best understood as the unique underlying rhythm or frequency of each financial instrument, determined by its historical price action its cyclical nature, and its fundamental characteristics. It's the idea that every stock or commodity has its own personality or vibrational speed, and to achieve high accuracy, one must integrate all relevant analytical factors, time, price, and volume, rather than relying on any single indicator in isolation. The core principle of comprehensive analysis is the interaction of three elements. No single factor, whether it's a specific time cycle, a Gann angle, or even a volume spike, is sufficient on its own for precise forecasting. True insight comes from the confluence of these elements. You're looking for confluences or confirmations, points where several of Gann's tools align. For example, if a 90-day time cycle is completing and price is simultaneously hitting a key one-by-one Gann angle, and that level also corresponds to a significant point on the square of 9, the signal for a potential reversal becomes exponentially stronger. This synergistic approach drastically improves the reliability of your predictions. For beginners, understanding the law of vibration can be simplified to recognizing that each market has its own unique historical rhythm and cyclical tendencies. Instead of seeking a magic bullet, you're seeking to understand this unique rhythm by observing its past behavior across different dimensions. The practical application of this secret boils down to developing a robust trading plan and adhering to it with unwavering discipline. Your trading plan should meticulously detail your criteria for entering a trade, exiting a trade, and most importantly, managing your risk. These criteria should be built upon the confluence of signals from various Gann tools. For instance, your plan might state, only enter a long trade when a 90-day cycle low is confirmed by the rule of 3 days and price is holding above a one-by-one Gann angle with increasing volume. Discipline and patience are paramount. Gann himself stressed the importance of waiting for definite rule-based trading setups. This means resisting the urge to jump into trades based on emotion or incomplete information. Overtrading or trading without clear signals is a surefire way to erode capital. A critical component of this comprehensive analysis is rigorous risk management. Always, without exception, define your maximum allowable risk before entering any trade. Use stop losses to protect your capital. This isn't just a suggestion, it's a fundamental principle of survival in the markets. Gann understood that even with high accuracy, losses are inevitable, and managing them is key to long-term success. Finally, incorporating volume into your analysis is crucial. Volume acts as a confirming factor. A strong price move on high volume is more significant than the same price move on low volume. Similarly, a reversal at a key time and price level, accompanied by a spike in volume, provides stronger confirmation of the shift. By combining these elements, you move beyond isolated observations to a holistic understanding of market dynamics. As we explore the rich tapestry of market history, understanding the context in which figures like William Gann operated becomes profoundly valuable. This is precisely why channels like Wall Street Memoirs are indispensable. They don't just recount facts. They bring to life the historical events, the seismic financial crises, and the legendary figures who shaped the very landscape of Wall Street. By delving into these narratives, you gain a deeper appreciation for the cyclical nature of markets, the enduring patterns of human psychology and speculation, and the historical precedents that often echo in today's headlines. It's an immersive journey that provides crucial context for understanding why Gann's methods, rooted in historical observation and cyclical analysis, remain so relevant. If you're fascinated by the stories behind the charts and want to enrich your understanding of market history, I highly recommend subscribing to Wall Street Memoirs. You'll find a link to their channel in the description below. In conclusion, while William Gann's methods promise an extraordinary level of accuracy, often cited at 90% or more, it is crucial for beginners to approach them with realistic expectations. Their application demands not just a superficial understanding, but deep study, consistent practice, and unwavering discipline. The journey to mastering Gann's principles is not a quick fix. It's a challenging yet incredibly rewarding endeavor that requires time and dedication. For beginners, the initial complexity can be daunting. Interpreting Gann angles accurately, applying the square of 9 effectively, and most importantly, identifying the confluence of multiple signals requires a trained eye and considerable experience. However, the reward for this effort is a unique perspective on market behavior, one that transcends the limitations of conventional analysis and offers a profound understanding of the underlying order of financial markets. We strongly encourage you to take the next step. Delve deeper into these concepts, backtest them rigorously on historical data, and gradually adapt these timeless principles to the nuances of modern market conditions. Gann's legacy is not just a collection of trading techniques. It's a philosophy that views markets as expressions of universal laws, a philosophy that remains profoundly relevant and offers a powerful framework for any trader seeking a deeper, more predictive understanding of the market's true nature. His ideas challenge us to look beyond the obvious and to discover the hidden symmetries that govern price and time.